Welcome to the webinar, and I hope you are able to hear me properly. We will be recording this webinar, so if you are not able to attend the full time, or if you have any issues in between, or those who are unable to attend, this will be available to you as a recording later on. What I plan to do is go through some of the applications that you would have gone through over the last few weeks, including applications of time value of money, something on bonds, and then looking at estimation of cash flows for capital budgeting. And after, you can, if you have doubts in between, you can give your comments or doubts or any clarification that you would want in the chat um, box, right? And I'll respond to it as we go along. All right. I hope you are able to hear me properly. Aditya, Shreyans. Okay, good. Okay, good. Thank you. So I will do these problems first, and then if you have any other questions or clarifications that you would need, then we can take that up later on. Okay. So the first problem that I would be doing is the one on time value of money, which is the first question that was mailed to you. This is the question about Manoj and how much he needs to be saving so that when his child is ready to go to college, they have enough funds, right? So a couple of parts to this question. The first is to understand how much should Manoj save? How much should Manoj save? And to understand that, we need to first have an understanding of what will be the cost of the engineering education in year 17, 18, 19, and 20 when Manoj's daughter goes to college, right? So we have some estimate based on which we can find out what is the cost that he will have to incur starting 17 years from now, right? And then how does he go about saving for that? Okay, so this question is a little is pitched at a level which is a little challenging. So particularly the later parts, where we have to find out what proportion of his income should he save every year, right? So that we'll come to that later, and this is a good question to help clarify how you need to go about looking at a problem that all of us face, right? We know for sure that there is going to be a need sometime in the future, maybe with regard to our children's education, maybe with regard to a purchase of something that we want, and we need to save some money towards that objective. And how much should we do that, right? So this is partly an exercise in financial planning as well, right? Which has broad applications for all of us. Okay, so the first part of the question is, what will be the cost of the first year of engineering college? Okay, so I'm going to use this Excel sheet, which is shared with you, and it's going to be recorded, so it will be shared with you later as well. Okay. So part A of the question is, what will be the cost of education? in 17 years from now. So basically the, right? So we know that the current cost is 50,000. And it is increasing at a rate of 8%. So this could be considered like an 8, inflation rate, or maybe something very specific in terms of cost of increase of just maybe education. And the number of years is 17. So the cost of education 17 years from now will be, how do we go about it? 50,000, right, into 1 plus 8%. Every year is going to grow at 8%, right? For how many years? For 17 years. And so we get the value of 185,009, or 1,85,000. All right. So that's the cost of education 17 years from now. So Manoj needs to save enough money to be able to send his child to college, and the first year of college education will cost 1.85 lakhs. Now this education cost it will be for 4 years. So then, so the second question is, what is the present value of the 4 years of engineering education if the opportunity cost is 11%? So present value of the engineering education, right, is what we need to find out, and the opportunity cost is 11%. That means if you save some money today, it will earn a rate of return of 11%. And we are assuming that you want to be a fairly sure that you would be able to earn this. So the opportunity cost should be something that is very much achievable, right? You don't want to invest in something which might fluctuate quite a bit. And of course, you have 17 years, so you have a long horizon to save the funds that is needed. All right. So we know the cost of education the first year of college, and that is this amount, right? Now college is 4 years, so cost of the second year this will increase at, again, the same rate as inflation. So it will become 1,99,000 in the second year. Again, this into 1 plus 8%, okay? And cost of fourth year is this will again be increasing by 8%. All right. So now, so this is the amount of money that he needs to have at the begin, and this fee needs, assuming that this fee needs to be paid at the beginning of each year, not at the end of each year. All right. So the fees needs to be paid. All right. So now let's look at what is the cost. Suppose you want to know what is the amount that Manoj should have after 17 years to be able to pay the full uh, tuition fee, right? What is the present value? So present value of the tuition fee or cost of college education um, of the 4 years, 17 years from now, how would we go about it? That means we want to know the present value in year 17. Now, the present value of the first year is 1,85,000. All right. The second year is 1,99,801. The third year is 215,785, and the fourth year is 233,047. Right. Okay. So what is the present value of 4 year of college 17 years from now? So that is at the beginning. All right. So if we do a timeline, right, and we say this is year 17, year 18, year 19, year 20, right? And the cost is this. In year 18, this will be the cost. In year 19, this will be the cost, 215,000. And in year 20, it will be this. All right. So what is the present value in year 17? What should be the discount rate to get the value in year 17? Anyone? At what rate should we discount these costs to, okay, yes, it should be 11%, right? Why 11%? Because the opportunity cost is 11%, right? Uh, if you had a certain amount of money today, you would be able to invest it at the opportunity cost, which is 11%. And we are assuming that the opportunity cost is going to remain constant throughout the years 17, up to years 17, 18 to 20. So essentially, to know what is the value of all these costs in year 17, we need to discount at 11%, which is the opportunity cost. All right. So, of course, the value of this in year 17 is that itself, right? So we don't have to discount it. This needs to be discounted by 11%, okay, for 1 year. This needs to be discounted for 2 years. And this needs to be discounted for 4 years. And so the cost of engineering education present value of cost of engineering education in year 17 is going to be the sum of all of these. All right. Does it make sense? Is it okay? So we have so essentially what we have done is we have calculating the value, the present value of the cost of engineering education when she will start going to college. All right. Now, what is the value of this today? What is the present value of engineering education, which is going to be the cost is going to be incurred from year 17, 18, 19, 20. What is the cost of that education in today? So year 0, let's say, right? So present value of cost of in year 0. Okay. So that is right now. That is today, right? We need to discount this by the opportunity cost for how many years? How many should be 1.11 raised to power of how much? 17, right? Okay, and we get the value, which is 117. 1 minute, let me just check, double check. So this is in year 17. Okay. So the yeah, there is some. Okay, there's a mistake here. It should have been just 3 years, not 4. Yeah, you're right. Damanita, you got it right. So Shreyan's also, yeah. So 1,20,530 is the present value of the 4 years of education. All right. Okay, so now, is this clear so far? Any questions? Is this clear so far? Okay. Now, let's okay, so now let's look at part C. Okay. So what proportion of his income should he save each year? All right. So now we know that his current income is 2 lakhs, right? And it's growing, the growth rate of income is 8%. So the income is growing at the same rate as the cost of education, all right? And he wants to save a certain proportion, a fixed proportion of his income each year for 17 years, all right? And the savings will earn 11%. Okay. So the question is, how much should he save? What proportion of his income should he save? Okay. Um, so here, this is where you need to be a little careful. Okay. This is where things can become a little. So let's. So at any, let's say, let's take any year. All right. Say, so year could be year 1, 2, 3, up to year 17, right? So 0 is current year, and 17, which is the first year of, all right. So the income in any year will be, I'm going to put this as a, in a comment, so that every 2 lakh into 1.08 raised to power of t, right? Is this clear? So in any year, his income will be increasing at a rate of 8%. So in the first year, it will be 2 lakh into 1.08. In the second year, it will be 2 lakh into 1.08 square. In the 10th year, it will be 2 lakh into 1.08 raised to the power of 10, and so on. All right. And now, so the present value of his income in any year t will be how much? We know we need to discount it by 11%, right? Because that's the opportunity cost. So it's 2 lakhs times 1.08 divided by 1.11 raised to the power of t. So essentially, the income each year okay. Are you with me? If things are not clear, just feel free to ask. Okay. So basically, we're finding out the present value of the income each year, right? So that is why we multiplied it by 1.08 raised to the power of t, and then we are discounting it by 1.11 raised to the power of t, because that's the opportunity cost and therefore the discount rate. All right. Now, he's going to, let's say, Manoj will save a proportion y of his annual income. All right. Now, if we simplify this, just insert a line here. Now, if you do a this comes to 0.197, okay, which is the inverse of right. So essentially, yeah, so let me just put it like this, 0.08. So we want this to be in the numerator. So essentially, this will be inverse of this is this much. All right. So essentially, we can write this equation. So each year he's going to save a proportion y, right? And he's going to, and the discount rate at which that savings is going to be discounted at is 2.78%. Why 2.78%? Because, if you divide 1.11 by 1.08, we get 1.0278. So essentially, the discount rate of his savings, net of the growth and the discount rate, is going to be 2.78%. All right. So let's say in year 1, his, let's just call it year. This will be his income. This will be the present value of income. Okay. So in year 1, his income is going to be and the present value of his income okay. So in year 2, it's going to increase at this rate. This discounted at 1.11 and so on. Okay. So if we do this, we'll keep increasing and so on. Now, we can do this the long way, but then it's 17 years is going to be a lot of calculations, right? Of course, with Excel, we can do it. But what we want is what proportion of y should he save, right? So Um, let me, it might be easier to write this out here. Um, so each year he's going to save proportion saved each year. Okay, why did we inverse it? Okay. Um, so essentially, um, we want to find out, okay, so essentially we have, okay, let me, I will just explain it right now. So each year we are going to save y times 2 lakh, okay, times 1.08 divided by 1.11 raised to power of t. All right. Now we want to have something like a equivalent of a discount rate. Okay, it's growing at a rate g at 8%, and we are discounting it at 11%. So the what is the net discount rate, so that we can then use the present value of an annuity formula. All right. So we can do this in two ways. One is you can use this as a present value of a growing annuity, right? Alternatively, we can find it out as a present value for regular annuity, where the discount rate is just the 1.11 divided by 1.08, right? Yeah, so we have this, right? So instead of this part, we write it as is that okay now? Shreyans, does that make sense? All right. So now we have a series of cash flows, all right, which can be discounted at this for, and we have it for 17 years, right? So if we have this series, and some of these should be equal to what? For t equal to 1 to 17, the sum of all of this should be equal to the present value of the cost of education, which is 120,530. Okay. And now, so essentially, now it's like an annuity, right? So we have this, I'm just going to write here, y, right, is going to be common. And 200, this should be equal to does this equation make sense to you? We want to save, we want to save, we want to know what proportion of the income should be saved, right? Now the present on the left hand side is the present value, given that he is going to save a proportion y of his income, which is increasing every year, and he can invest the savings at 11%. The left hand side gives the present value of all his savings. All right. The right hand side gives the present value of the amount that needs to be saved. Present value of the amount that needs to be saved. Is that all right? Debonita, does it make sense now? Left hand side is the present value of the savings. The right hand side, present value of cost of education. All right. So now we have these two equations, and the only, is that clear? And now that we have these two, this equation, do you see some patterns? So for example, on the left hand side, the term in the bracket is like an annuity, right? And then we can apply the present value of an annuity formula to find out what is the present value of what is the term within the brackets on the left hand side. All right. And then we have to solve for y. Okay. So is that clear? Shreyans, does it make sense? Given this, now on the left hand side, we can simplify this matter using the annuity formula, where the, so it's an annuity, right? Has some features. So the annual cash flow is 200,000. The R is 2.8%, and N, the number of periods, is 17. Right, so we can write this and if you solve for this, this comes to and solving for y, we get y is equal to 4.5%. Okay, so essentially what it means is every year Manoj needs to save 4.5% of his income to be able to save the present value of 120,530, and yeah, he will save from year 1, 2, 3, 4 up to 17. There will be no, by 17 he has saved up enough money to be able to pay for the entire education for year 17, 18, 19, and 20. All right. So this is an application of the present value concept to a financial planning situation. All right. The last part is a little tricky, but I thought I'll expose you to a little bit more um, trickier application. It's not trickier, but you need to be a little bit more careful. All right. Now you can do one thing as an exercise. Um, find out what is the, if he's going to save a certain, this 4.5% of his income every year for 17 years, what will be the future value of that at the end of year 17, right? And that will be the amount that would be needed for the daughter's education. All right. Okay, so I'll share this slide with you. Do you have any questions? How do I see the? Yeah, so after year 17, there will be no savings. That's right. Okay, so let's go to the second problem. Okay, so let's look at the YTM problem, right? So here is a bond, right, with a face value. Face value is how much? 10,000. Okay. And it's paying a coupon rate of 6%. Okay. And it matures from 2001 to 2006. So if we draw a timeline with 2001 being now, and the cash flows. So in year 2, in 2002, the bond will pay this into the coupon rate of, all right, and that's how much it's going to pay every year as a coupon, right? And in the 2016, it will pay back the face value as well. Okay. And the yield to maturity, YTM of similar bond is 4.8%. Right. So what is the present, what is the value of the bond? So the value of this bond is, we need to present value of all these cash flows. We need to discount it at 8%. So this divided by, sorry, by 4.8%, which is, because that's the opportunity cost, right? This raised to power of 2, this raised to power of 3. is 10,522. So this becomes the opportunity cost. Okay. Now this bond is trading value is higher than the face value. Okay. Why is that? Why is this bond having a value higher than the face value? Yeah, YTM. The yield to maturity is less than the coupon rate. The coupon, yes, that's right. The coupon rate is 6%, whereas, so this bond is paying 6%, while the opportunity cost available in the market is paying only 4.8%. And therefore, since this bond is paying more than the opportunity cost, investors will bid up the price of this bond so as to enable investors to get only the market rate, which is the opportunity cost. So suppose you buy this bond. So let's say you buy this bond, you buy the bond at 10522.42. Okay. What is your IRR? What is the rate of return? So if we do these cash flows again, now here the cash flow is you're going to invest 10,522.4 to buy this bond. So its minus sign indicates a cash outflow, and then you're going to get 600 every year for 5 years, right? And then you'll get the 10,000 as well, right? So what is the IRR? The IRR for this, if you calculate, exactly 4.8%, right? So the IRR at this price works out is exactly equal to opportunity cost. All right. So this is that YTM example. This is the financial planning exercise. All right. Is this clear? Okay. So let me, it's going to be close to 7:30 now. Let me do the capital budgeting problem. All right. So I've sent you a capital budgeting problem. Okay. So I will do it here. Now here we can, this is that buying that earth mover. Okay. So we can divide we need to estimate the cash flows. Okay. So the first part is estimating the investments. So there is the price of the machine, which is 5 lakhs. Okay, then there's a modification cost, which is 1 lakh. Then there's an investment in working capital, that's 20,000. So total investment is 6,20,000. Okay. The operating cash flow, let's estimate the operating cash flows. So in this case, the revenue is going to remain the same, right? But essentially, there's going to be some tax cost saving because of this machine, right? And essentially, it's saving in labor cost. So let's say we have the information that so essentially we need to look at what is the impact on the bottom line because of the lower cost of operations because of this machine, right? So before tax cost saving, right, is 2 lakhs every year. And the idea is that after 3 years, the machine will be sold. So we are looking at only the 3 years. Okay. Now, since the tax rate is 40%, and we want to estimate what is the we want to estimate the after tax cash flows. So the after tax cost saving, right? So if the savings costs come down by 2 lakhs, right? The before tax income, profit before tax will go up by 2 lakhs, isn't it? And on which you have to pay a 20% tax, 40% tax rate. So actually the after tax cost saving is 2 lakhs into 1 minus the tax rate, right? Because 40% of the tax saving of the cost saving will be taken by the government in terms of higher tax. So what you get after tax is only 60% of the cost savings. Is that okay? This is the after tax. We are doing this since revenue is not affected. Yeah. Yes. So, and the other issue is there is a depreciation that we can claim on this new machine, and there's going to be a tax benefit on the depreciation, right? So the depreciation, now here, I will insert some lines here. So depreciation rate so depreciation rate is how much is it? it's varying from year to year. 33, 33%, 45%, and 15%. Okay. Sometimes in some situations you might have an opportunity where you can have higher depreciation rates in the beginning, because then you get more tax saving. And sometimes governments do this in order to encourage firms to invest more, particularly when there are a slowdown in the economy. They might say, okay, we will give a higher depreciation rate so that firms can have a higher after-tax cash flows. Okay, so the depreciation each year. So the amount that can be depreciated is 5 lakh plus 1 lakh, okay, into this rate. So this is the depreciation. So the depreciation tax shield is this into 0.4%. All right. Why is this? Because of depreciation, you're saving tax, and that is this amount each year. Okay. So so the impact on the after-tax cash flow will be higher to the extent of this plus this. All right. Now, this is the operating cash flow. At the year 3, we are going to sell this machine, right? And the salvage value and end of project cash flows. Let's call it end of project cash flows. So we have salvage value which is, the idea is, it is estimated that you can sell it for 2 lakhs, right? Now, what is the book value of this machine? So the book value is you invested 5 lakh plus 6 lakh, right? But then you depreciated a certain amount. You claimed so much of depreciation. And therefore, the book value is only 42,000. That means in the books of the firm, the value of this asset is only 42,000, because from 6 lakh, you've depreciated a cumulative depreciation of all of these amounts, and therefore in the books of the firm, the it comes to 42,000. So actually here in this depreciation amount, it's not the same as the written down value method. So essentially, I'm replying to Shreyan's question. The depreciation rate in each of these years is different. Okay, so that's why we have the depreciation of varying amounts each year, and we are not looking at the rate is not applied on the balance amount. All right. So this is the book value. So the capital gains on the asset, on the equipment, is this difference. 2 lakh, you sell it at 2 lakh, but value of the asset on the books of the firm is 1,58,000. Okay. Now, on which you have to pay tax. So you have to pay 0.40, assuming it's the same tax rate. This is. So the net salvage value is, you get 2 lakh, but then you have to pay tax of this amount. You get only 1,36,800, right? But there is another cash flow that you will get, which is the recovery of net working capital, which is this amount, right? So cash flow at the end of the project is a sum of the net salvage value plus the recovery of the working capital, right? So we have now the cash flow estimations, right? So let's put it down here, timeline and the cash flows. In year 0, at the beginning of the project, we have to invest this amount, total investment. Okay. In year 1, the cash flow is equal to, it's going to go up by 1,99,000. In year 2, by this, plus this amount as well. Okay, so you have the cash flows. Now, what is the opportunity cost? Discount rate is 10%. So the net present value of this project I know you have just started looking at cash flows and so on. So this is a little early, but I suppose you are able to follow. It's not a percentage, so let's look at just a number. It's minus 15,468, right? And if you calculate the IRR, it's 8.68%, which is less than the discount rate, right? So the IRR is less than the discount rate, and we find that then NPV is negative, right? So given this, should we go ahead with the project, with this investment in the in this project? Yeah, we should not go ahead, right? Because the NPV is negative and the IRR is less than the opportunity cost, right? So NPV negative and IRR is less than the discount rate or opportunity cost. And so we should not invest in this project. Okay. Okay, so you know, you have another about a week, right? And then the final evaluation exam and so on. So essentially the evaluation will look at these different topics. Of course, it will be at a level that you should be able to handle very well. Okay. So, now I'll open it up to questions, or if you want any clarifications, do write in the chat box, and then I will take it up. Or do we get them to open it up for them to? Yeah, that is also fine. Yeah. Yeah. So, okay. Actually, just wanted to clarify, since we are not being allowed to even use pen and paper for exams, asked to use only the online calculator. Um, okay. So, actually, the level of questions would be such that you would not need an Excel. Okay. Um, so that gives you a clue, right? Um, so you will you know you should be able to do the questions without an Excel itself. So that should not be an issue, but you should have a calculator with you. Okay. Um, so we can we use a local? You mean a separate calculator from? Um, okay, so actually, this question about whether Excel is allowed and all, let me get back to you. I'll send out a mail, or the team will send out a mail to you tomorrow whether Excel is allowed. Okay. The questions would be such that you wouldn't need Excel. Just basic calculator should be enough. Um, okay, but I will clarify this question about need for Excel uh, by an email tomorrow. Okay. Okay, how do we factor in inflation while calculating the present value? Okay, so yeah, that's an interesting question. So essentially, when we look at cash flows, uh, we the discount rate, right, uh, should take that into account. The discount rate. So, for example, if inflation rate is 4%, the rate of return will take that 4% inflation into account um, in the market, right? So the opportunity cost available in the market will take into account the not the past inflation rate, but the expected inflation rate, right? So uh, there are two things to do. One is when we forecast the cash flows, those should be what is called nominal cash flows. That is cash flows including, let's say, the impact on inflation, right? So um, so this is the so we okay, so that's a question, right? So one, oh, this is a private one, not to everybody. Can everybody see it? Or? Okay. Okay. How to take care of inflation? right? So that's the question. One, in the cash flow projections, factor in inflation. Okay. Example, in sales revenue, factor in the inflation in the price of goods sold. All right. Similarly, in costs. All right. Second thing is, in the discount rate, the inflation should be factored. Okay, so the opportunity cost should include the inflation factor as well. Usually, so, and usually the market rate takes the inflation expectations into account. All right. So, how do the answer to the question, how do we factor in inflation? One, in the projections of cash flows, we need to factor in, take into account the inflation, both in sales and costs, as well as in the discount rate, where the opportunity cost will reflect the inflation rate. So, for example, in countries with higher inflation, like let's say in Zimbabwe, right? The inflation, the interest rate in Zimbabwe will be much higher than the inflation rate. Now, in countries where the inflation rate is very low, such as in Japan, the market interest rate will be very close to zero, right? So, the market takes the inflation rate into account in setting what the appropriate rate of return should be. Is that clear? Okay. Any other questions? Feel free to ask. We'll have to close soon because it's getting close to 8. Can we use a manual calculator instead of an exam on-screen calculator? Shreyans, and you know, I will get back to you with regard to, you know, the use of calculator, if it is allowed and so on. There must be a policy that everybody follows, and I'll let you know what it is. All right. Okay, so if there are no more questions, then are there any more questions? Okay, then you know, appreciate all of you joining in for the webinar, right? And we'll, you know, if you have any queries, do mail in, and you know, I will get back to you on the use of the calculator and Excel tomorrow. All right. Okay. Have a good evening, and you know, you will have a mail from me tomorrow, and these will be shared with you as well. Okay. All right. Bye bye.